Welcome to the Apprentice Trading Library. In this segment, we will explore and answer the question, what is an option contract? An option contract is a type of financial agreement that gives you the right, but not the obligation, to buy or sell an underlying asset, like a stock, cryptocurrency, commodity, or index, at a specific price, known as the strike price, by a specific date, known as the expiration date. Think of it as reserving the right to buy or sell something at a set price by a certain time without being forced to do so. Let's take a look at the key elements. First, who are the key players and what are their roles? The buyer pays a premium, known as a fee, to acquire the option contract and has the right, but not the obligation, to exercise it. The seller receives the premium from the buyer and has the obligation to fulfill the contract if the buyer exercises it. Now, let's consider the key points of an option contract. First, there are two main types of options: call options, giving the right to buy, and put options, giving the right to sell. The exercise date is the specific date by which you must decide whether to exercise the option or let it expire worthless. The expiration date is the final date after which the option contract becomes null and void, even if you haven't exercised it. The intrinsic value is the difference between the current market price of the underlying asset and the strike price of the option. A positive intrinsic value means the option is in the money, and you could potentially exercise it for a profit immediately. And time value, which represents the remaining time until the expiration date and reflects the potential for the underlying asset's price to move in your favor before the option expires. Next, we'll explore the uses of option contracts. We have speculation, where you can use options to speculate on the future price movement of the underlying asset. Buying a call option bets on a price increase, while buying a put option bets on a price decrease. There is also hedging, where the options can be used to hedge existing holdings and protect against potential losses. For example, buying a put option on a stock you own can limit your downside risk if the price falls. And we have income generation, where the selling of options, known as option writing, can be a way to generate income. But this also comes with risks and requires a good understanding of market dynamics. It is important to note, options are complex financial instruments with inherent risks. It's crucial to understand the mechanics before using them. Leverage can amplify both your gains and losses, so start small and manage your risk effectively. Option strategies can be intricate and require proper planning and execution. Consider seeking professional advice if you are unsure about a particular strategy. Thank you for watching the Apprentice Trading Library. Please visit verifiedinvesting.com for more.